Hell yeah. All right. Let's go into the diamond hands talk and how I have a high win rate on these end of day lottos. Obviously, today was a bust, but you were able to get some profits if you got that 10, 15, 20% move. Okay. Diamond hands is the first thing. I know that it's not ideal for a lot of folks to be in drawdown, and so I'm trying to get better at finding the plays at the right time. And we got better at them almost like immediately this morning when I said, hey, we're going to sweep this level first before going down or going higher, right? So we got exactly that. Same story yesterday, actually. We got those calls, the 690 calls around here, and they ended up going 220%. But the reason I have confidence in those plays isn't because of anything that George says. I mean, that's good confidence, don't get me wrong, but it's not because of George solely that I'm taking those plays. It's more about, do I understand where the market is heading, and do I understand where liquidity is, right? And I think you've all heard me say this for the last year. I think most of you have interacted with me for the last year. To me, liquidity is really all that matters, because if you can stop at a bunch of people that have their stop losses here, for example, then you can go higher because they're now giving you that liquidity so you can go into the opposite direction or continue dumping. And typically when the liquidity grab happens, you're able to go higher, and a lot higher really quickly, because there's a lot of people with stop losses at particular levels, right? So let's get rid of all the levels here, because I want to show you exactly how I do it first, so you can build your confidence in where there might be liquidity, where there is no liquidity, and where the market is likely to reverse course, right? And so if I look at it on the daily side, and I know this might be repeat to some of you, but I want to make sure that all the new Bob's members understand how George works fundamentally. And he works on liquidity. He works on key levels that are interesting to market makers. And he understands that when people start to panic, he's able to buy the opposite direction for a really good price. And trading is fundamentally a probabilities game. It's a numbers game. If you have a 51% win rate, you're going to be profitable compared to any other person in the world that's trading, right? And the way that I think about this is, if you have 51% probability, you can figure out what you're doing right and double down on that, and take out all the bad learnings where you're losing that 50% or 49% of the time, right? Right now, as it stands between myself and George, and I think Timmy's like this too, like we have a 90% win rate, and we're going to lose 10% of the time. That's totally fine. But I guarantee you that losses are the norm in this industry, not the exception. The exceptions are the wins that we've had over the last couple months, couple of years as traders. And so George fundamentally was built around that idea. It's like when people are panicking, you want to do the opposite, because you're going to grab liquidity as a market maker to go into the opposite direction, which happens 9 out of 10 times, as we've seen over and over again. So let's go and understand how I mark the levels. And this is transferable to Bitcoin, Palantir, Coinbase, the S&P 500, any sticker, any stock. It works fundamentally the exact same way. And so what I'm trying to instill in you here is not just like, hey, use George for confluence, is to chart yourself and understand how to trade it, why I'm trading this, why George is trading this. And I know that the direction, if I'm right 90% of the time, I'm happy with the drawdown, right? I don't use stop losses. You've all heard me say this. I think you should use stop losses, but I know in 90% of the cases, I'm going to be right in that direction. I'm happy to stomach that loss. Now, I've gotten better entries, don't get me wrong. I've gotten really good at entries, especially with the crew here over the last couple of weeks, but I want to make sure that people understand fundamentally where I'm coming from. Any questions before I show you how I mark the levels of liquidity or what I'm looking for on a daily basis when I'm doing the trades? Going once, going twice. All right, no questions, perfect. And by the way, I want to show you the daily chart here, because when you're in a trending market, when you're making higher highs, higher lows, higher highs, higher lows, any stock within the S&P 500 or whatever the ETF is, it doesn't really matter, will do well. It'll 100% do well, right? But we're not in a trending market when we haven't been in a trending market. And you've heard me say this morning since October 27th. What happened there? We went down, we went up, we went down, we went up, and now this is compression. This is compression. It's getting tighter and tighter and tighter and tighter. We're either going to break towards the upside and go towards like 750, or we're going to go down really hard towards that 650, 630 area, right? And I don't know what we're going to get, so we have hedges in place. I think most of you know that I have a 650p hedge for March 20. I don't know if that actually does anything or expires worthless. I frankly don't care. It's a hedge because I've been investing in these markets for the last 8-10 years. And my worst performers, at least for the past, I want to call it like 4 or 5 months, has been the technology sector. Like Microsoft was literally my worst performing stock this past year. Apple was my worst performing stock this past year. If you had told me that a year ago, I would have not believed you, but this is where we find ourselves, right? The money is outflowing from the S&P 500, from technology into other sectors. And we can track that on the George page, but we can also look at particular stocks, because right now we're in a stock pickers market where that money might be flowing. And that's the reason I built that page in particular for George. It's because for me to calculate that, or for me to understand where liquidity is actually going, it's going to be really challenging. But George has data and access to all these different assets, all the different sectors, all the different ETFs. And he can give us his best picks based on how he understands and how I understand liquidity and where the market makers are going to be positioning themselves, right? So we know that we're not in a trending market anymore. This was higher highs, higher lows. Now we're in compression mode. This is called accumulation. And we're either going to go up really fast or go down really fast. It might be a repeat of last year, where from February 21st until like April 7th here, we just continue to dump and dump and dump, right? This is also partially a trending market where you're setting up lower highs and lower lows, but we're not there yet. So I don't want to swing puts either unless they're hedges, because I don't know which way it's going to go. It could go towards 750 on the S&P 500, or it's going to go towards like 650 or 630, whatever that level is, right? So we know with 100% certainty right now, we're not in a trending market. But the way that I look at liquidity, and George works fundamentally the same way, is where do you have pockets of liquidity that have acted as previous support and resistance? Now, I personally don't like the term support and resistance, because the way that I think about markets and the way that George thinks about markets is only liquidity. So in the classical terms of inner circle theory, or ICT for short, you have buy-side liquidity and you have sell-side liquidity, right? And sell-side liquidity is always going to be at below relative equal lows, and buy-side liquidity is always going to be above relative equal highs. And it doesn't matter if it's on the daily, on a 4-hour, 15-minute, 5-minute, doesn't really matter. You're going to see this exact same pattern. So what I do, and I've done this, and we haven't broken out of this range since October, so I've not had to remove any of the levels here, because we've been ranging between the low and high for the past 4 months, but I haven't had to do anything here. So you have a low here, 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 low here, low here, low here. This to me is a good quote unquote support zone. This is where I know there's a bunch of stop losses. And you've seen me draw this multiple times, but if I'm taking longs, and I know it's not the same for futures as it is options, but it is very comparable. If I'm taking a long on the S&P 500 or whatever the stock is, and I'm getting in at, let's say, 677.60, where that liquidity is, my stop loss is going to be below that. It's going to be like, 1, 2, 3, maybe 5% below that. Let's go measure this move out from the low to this. It's going to be like 1% below that. That's exactly how most retail investors and even institutions, frankly, work. And so what happened here, we broke this level of quote unquote support. We grabbed a bunch of liquidity, and what did we get higher? We just went over this. What did we get afterwards? Without even looking at the bar here, what's going to be the most likely scenario once you've stopped out a bunch of retail and institutional investors? You're going to go higher. That's just simply how it works, because that's when you can grab all the stop losses, all the liquidity that's been built up in this area, and now you can reverse course. And what do we get after the stop loss hunt? We ended up moving up and up and up, right? And this level has been tested multiple times. So until we break 677.60, I don't want to swing puts, frankly, because the risk and reward for me personally is not there. And it shouldn't be for you, because you're going to lose that unless it's a hedge that's designed to go to zero. You're going to lose that capital and give it back to the market makers, who can then reverse course and go higher, right? So until we break the 677.60 area, I'm not interested in buying puts, because I know the next level of support below this is at the 652 area, right? And we've seen a bounce there 1, 2, 3, 4, 5 times. So I know if we're breaking below this on a daily time frame, you're going to go towards this, test the buyers that are still there, and they are going to be there, I guarantee you. And that's when you're going to go up towards the upside. It's okay. We got 2 key levels here. We got 652, 56, 677.60, and they don't have to be perfect. They don't have to be fully accurate. You just need to know and understand where there's levels of liquidity with 80% certainty. It doesn't have to be 100% certain at any given point in time. Now let's do the opposite. Where's the buy side liquidity? So any buyer that has shorted around this level will have their stop losses, 1% above here. And what happens every single time we get a liquidity rate up here, we go down, right? And so on the daily time frame, it's pretty easy to play this. I find it pretty easy to play, at least, where I can look at this and be like, oh yeah, there's a bunch of stop losses around this level, because that's where all the people that have bought here are going to be positioned, right? Whoever's bought at this candle at 691 will have their stop loss at around 695, 694. And what happens every single time we test that zone, we end up going down, right? And you can see this plain as day on the chart. And I'm using this short and long thesis, or this drawing here, as a way to tell you where my stop losses are and where my take profits are if I'm an institutional investor. And this is exactly the kind of thing that George looks at. He's like, where are my stop losses if I'm an institutional investor? Where are my stop losses if I'm an algorithm, right? He's looking at that. He's better at doing it than we are, frankly. And he can correlate multiple things. Like you've heard Timmy say things about physics, about genetics. You heard me say things about gamma exposure, previous day low, previous week low, previous month low. We've coincidentally, believe it or not, reverse engineered an order book, right? And we don't have order book data. That thing is like $15K a month. We don't have that kind of data. But fundamentally, what we've done by sheer luck and coincidence, if you want to call it that, just based on our knowledge and how things work, is we've reverse engineered an order book. We know there's stop losses, there's liquidity, and we can now go towards the opposite direction once that liquidity has been swept. Okay. So we've got two levels of support here, and they don't have to be perfect. I just want to show you how that works. And then we have buy-side liquidity, or liquidity from people who are shorting the market up here at 689.27. And then you have a lot of levels in between, right? We can do this all day and every day, but I just want to show you, for the most part, where that layer of liquidity is. And so now we've done this on the daily. I can come down to the 4-hour. I personally love the 4-hour chart because this gives me a lot of context and a lot of information around where there's key buyers for intraday moves, not like swings for a week or a month out, but intraday moves, like what's happening the next day, the next 3 days, the next 5 trading days, right? That's really what I'm looking for on the 4-hour chart. So I know there's a bunch of serious buyers at 677.60. We've marked it up on the daily chart, worked out really well. And once we test that level over and over again and stop them out, what happens? We get a reversal to the upside. What happens here? We get a reversal to the upside. And once you can layer the patterns that you see from the liquidity, you can then layer in other patterns that you might see other people practice, right? You have an inverse head and shoulder, inverse shoulder here, left shoulder. You have your inverse head and inverse right shoulder. You moved up. Same story here. Inverse shoulder, head, right shoulder, moved up. Inverse head, shoulder, head, right shoulder, moved up. And then the opposite is also true. You might have a head and shoulder pattern, right? You might have a head here. Let's go find an example. Head here, left shoulder here, head, right shoulder, move down. But the down moves have not been as drastic as the up moves have, right? There are instances, but for the most part, markets work this way, where they're more leaning towards the bull side. And unfortunately, we're not in a trending market anymore. We're in a consolidation market because market makers themselves and people with big money, like institutions, like hedge funds, big educational institutions, people that are managing these ETFs and pension funds and all this other stuff, they don't know what to do with the market right now because Trump might say something random tomorrow and say, hey, we're going to tariff the hell out of like every other country again, and like we'll go down 10, 20%. Or all the tariffs might be off in like a week and, they're issuing refunds. And we might still nuke on that news because now all the technology companies and all the retail companies that have been paying these tariffs will have to refund the American people, right? And that might also happen. I have no idea what's going to happen. So even institutions are like, we don't know what's going to happen. We're not going to deploy as much cash as we used to. And so this is why we've been stuck in the range since November, because people aren't sure what's going to happen. But as traders, it gives us a really good opportunity. And again, it's a probabilities game. It gives us a really good opportunity to figure out where the moves might be intraday, and let's go and figure out how to capture those moves. It's a really good time to be a trader. It's just unfortunately a bad time to be an investor. That's how I see it. So we got a couple of levels here on sell side liquidity or support, if you want to call it that, and buy side liquidity or resistance, if you want to call it that, right? So this is on the 4-hour, and I can see what's going to happen with 90% accuracy for the next day, right? So I want to see a gap up tomorrow and then hit that 690, 89, 90 area and then reverse down on Monday. That's kind of what I'm expecting. We also got OPEX tomorrow, so I don't know what's going to happen. But that's what the 4-hour chart tells me. If I got to the 15-minute, and you saw me do this morning, I literally just marked out the level from the intraday. So I said, here's your local high from the couple days before. Here's your local low from a couple days before. And then here's another layer of liquidity that was previously resistance and previously also support, right? So you have a level here that is really keen to look at. And so for instance, yesterday and today, what I was trying to do is really optimize my entries because I'm personally comfortable with the drawdown. And I have diamond hands because I know with 90% certainty and 90% win rate, I'm going to get to the number that I want and the level that I want in 90% of the cases. But what I've started doing is making sure that you understand where I'm seeing there's going to be buyers or where there's going to be a reversal and getting the entry at that exact same price at the exact same time. So you saw this happen today and yesterday where I said, hey, we're going to undercut here. We got exactly that. We undercut the 683 area, went down to that previous line that I drew at 682. That's exactly what I said in the Discord message as well. We got our entry here, and then that went up 100%. And then I sold most of them at that point in time because I knew that once we did the undercut, and this happens right now all the time in any stock, any ETF, any index, we're going to undercut. Market makers are going to undercut because whoever is going long on the intraday candles, they're taking their longs around here. Whoever went long yesterday got stopped out today on that undercut. And what happened afterwards, we reversed up, right? Same thing happened yesterday. We hit a bunch of people on the stop losses who went short at this level. We redid our liquidity once again on the intraday, and then we reversed down, right? So this is like that, the drawing there. And we reversed down towards the next level of quote unquote support. So that's how I've been playing this. And it's a really good time to be a trader because I can understand that once we do the undercut, whether it's above or below, we're more likely than not, and this happens again in most cases, it's not going to be the reality for every single situation because every single situation is different. But on average for the last year, and I've been tracking this because I have my own journal here that I track, in most cases, once you undercut either above or below, you're going to go towards the other level, right? So this is the level that I was watching for. We never got there today because of accumulation. It's Thursday. Trump's going to say something at 4. There's going to be OPEX tomorrow. So we never got here, but this is really where my target was. And we got there yesterday. So this is how I was able to get that 220% move. Like we did the undercut, exactly what I thought was going to happen. We entered here. I held through it. We had a manipulation candle at one point in time where that entry was down by like 10%, I believe, if I remember right. This was the candle that it was down 10%, even though we entered here. It's fine. I was like, I'm just going to hold it because I know my target is to scale out of that position is here and it's here. And we got exactly that. I ended up scaling out of that position at 100% here. And at 220% here was like my last target. If we hit it, we hit it. But I was able to scale out of that contract at plus 100% and some change. So I made my initial capital back. And I had a nice profit of like 25, 30%. And I left a couple of runners just to see what would happen. And if we get to that higher level or not. Same story today. We didn't get as drastic of a move. But we did get something where we were able to get that 100%. We got the 100. We entered here. We got the 100%. I told everyone to scale out of here. We scaled out, left a free runner because I was hoping that we would get to that 690, 89, 90 area, but we never did. That's totally fine. It was a free runner at that point in time, right? So that's how I think about this is once you grab that liquidity and you have a really nice entry, you're more likely than not go to the upper target. And then once you close above this, on the 15-minute, at least that's how I use it. On the 15-minute, if you close above this, you're going towards that 689 area, right? And you can see it clear as day here. We ended up getting an impulse, close above it. What happened? You went towards that target that I had up there, right? And we never closed above 689.90. So this is where I was saying you can probably buy puts because you're going to go down to the level below. And we ended up closing even below that, basically negating all the gains from the day before. So this is just how price moves. This is how algorithms work. This is how George works. He understands where there's levels of liquidity and where there's a bunch of stop losses, whether that's from retail investor or institutions, doesn't matter. He knows that that's there, and he can use other tools like physics, genetics, gamma exposure at certain levels to figure out where there's support and resistance. So that's how I've been doing this, and I think we're getting really good at the entries, and we're going to get really good at exits pretty soon because now we know how to get into a position. It's just as important that we understand how to get out of a position or scale out of it. And again, if you're doing calls, these are your targets. These lines are the targets for when you want to scale out of that position and leave a runner in case we do go higher. And it doesn't always happen, but it does happen sometimes, right? And if you're taking a put position and you're, let's say, entering here, your target to scale out will be around here. Then your last target to scale out will be around here, right? So that's how I think about this is once you have the levels of liquidity marked out, you can take very strategic bets and be right like 50% or more times, knowing that you have a target in mind for when you want to scale out of those puts or target in mind when you want to scale out of those calls, right? So that's how I trade this. That's how George trades this. That's how everyone, frankly, in my opinion, should be trading because trading does not need to be complicated, right? I think there's a bunch of people that love using divergences, looking at other tickers, looking at the difference between how QQQ and SPY are moving or SPX and RUT are moving. And that's totally fine. If it works for you, it works for you. But I'm an idiot. I'm the dumbest person in this room by far. So what I understand here is what I think you can train yourself with. And it's not that hard to learn. I don't have an education in trading. I have not been trading for 20 years. But what I know about how price moves is moving between level to level. You're able to capture these moves in the simplest way without using a lot of indicators, without having to look at a lot of data. And you can do this yourself very effectively. And again, we're not in a trending market, so I don't want to send calls. I'm only going to hedge with puts because we're in this accumulation phase. If you gave me like another chance of going back in time to April or May last year when I started the trading journey here, I would have sold calls every single day. I would have probably made a lot more money than I did because I was scared back then. I was like, I don't know how levels work. I don't know how liquidity works. And I was just trying to get my head around like how to do it the right way. And you should ask me questions, like 100%. Ask me questions whenever you want, because the way that I understand markets is how mechanical systems or how algorithms fundamentally work. They're looking at levels because they can't see charts, and looking at charts is really hard for AI systems or algorithms. It's not impossible, but it takes a lot of computational force. And I'm trying to keep this as cheap as possible for people, right? But the way that I program George and I program myself, frankly, is to look at where layers of liquidity, where we're more likely to reverse. And then from there, I'm going to set my positions once we hit that level. And hopefully that works. It's continued to serve me well and has served me well for the last year. And if it doesn't work in the near future, I might change my strategy. But the simpler the strategy you have, the better it is, frankly, in my opinion. Because once you add in like 20 different indicators, and believe me, I've tried everything. I've tried so many indicators. Like, look at all the favorites that I had. I used to look at so many of these in my early trading career, and none of them worked. And I was like, I don't know what I'm doing here. Like, this is just overwhelming. Like, I don't know how to read this chart. If anyone does, and it's working for you, go for it. But for me, it was not working. I was looking at this. I'm like, I'm confused. Like, what's going to happen here? What should I do? Should I buy a call? Should I buy a put? No idea. So I've tried all these things, and they don't work for me. And if they do work for you, great. But I'm comfortable trading just on liquidity because we're not in a trending market right now, and I don't want to be the guy going out and swinging calls like crazy because we're not there. Like, I can see it on the daily chart. We're just not there. So this is how I'm doing it. I'm looking at where there's key levels of liquidity. We've had it here. You went up. You close above this, you're going to go up there. If you close above this, you're going to go up there. If you're closing below this, you're going to go down here. If you're closing below this, you're going down here. If you're closing below that, you're going down here. To me, it's that simple. And this is a strategy that I developed for myself and for George because it's the simplest strategy I could think of, given my limited knowledge and experience in the space. And it's continued to serve me well for the last year. And that's how I have diamond hands. I trust the process. I trust that in 10% of the time I will be wrong, and I'm happy with the losses. But the wins that I have here far outweigh the losses for the most part. The only thing that has messed me up really is the investor mindset, where all the companies that I thought were good companies like Microsoft and Apple have just not served me well. I would trade them. Don't get me wrong. I'll trade Microsoft calls and puts and Apple calls and puts whenever I want, especially on Thursdays. But I don't really want to hold them for the long term until the market comes back to that trending environment, right? But it's not there. So as an investor, I'm just sitting out. Like, I've made more money trading than I have as an investor in the last 18 months. That's just the reality. And if you're an investor and you're looking at this, I think you got to take the trader mindset and understand what is the simplest strategy that will help me get to the profits that I want. And can I turn $200 to $400 on a daily basis? That's really what I'm doing right now because that helps me pay my bills. And that's all I need to do. I don't care about long-term investing at this point in time because the market is not trending and everyone's worried about a 10, 20% correction. That might happen. I don't believe, frankly, personally, that that's going to happen because the market dynamics are totally different, where earnings have been pretty good for every single person, for every single company in this industry. I don't know if we're going to get some crazy tariff news that we got last year. I don't think that's actually the case. So I frankly don't see something like this happen. Maybe we get like a 5-10% correction and bottom out at like that 677, 670 area and then go up. But I'm not going to take the bet right now when we're in this consolidation phase, accumulation phase. Once I get a clear break above or below, then I'll swing puts and calls all day. But we're not there yet. So that's how I'm thinking about the diamond hand situation, is if I know where my targets are and I know in 90% of the cases I'm right, then I can hold that drop down, or better yet, which is what we've been working on for the last couple of days, just find the right entry at the right level. And from there, you're going to more likely than not reverse up. Any questions before I continue with other stuff? For key levels, do you want to draw all the sweeps? Not really. You could do it that way if you wanted to. I just don't think that's the right mindset. I think the better question to ask is, how do you identify the key levels, right? And I think the best evidence for that, honestly, is on the daily chart. And even on the 4-hour chart, I think you could look at it that way as well. So I was telling some folks here, there's a lot of good buyers at 676, 677, because that area has been defended on the daily side. Let's go look, right? Let's go count them. 1, 2, 3, 4, 5, 6, 7 times. And are you telling me that there's, a few billion, 40, 50, $100 billion worth of volume at this level and that people are buying it at, that they're not there, they don't want to get it at a discount at the same price in the hopes that they can get towards that 697 and make a $20 return there per share that they bought? The answer is most likely not, right? Like they want to come back to that break-even point or maybe even lower so they can buy it up, right? And until we close below, and this hasn't happened except for this one day, and a couple days here, until we close below the 677.60 area, I just don't feel confident in using puts as outside of a hedging strategy. I don't want to swing puts here because I don't see this level breaking right now. It might break in the near future. I have no idea. No one can predict the future. But you have a key level here at 677.60 where multiple times it's been defended, right? So daily and the 4-hour tells me with full conviction that there's strong buyers here, or not even full conviction, high probability that there's a strong buyer here or multiple strong buyers here. But I also know the inverse is also true. So if I get rid of the levels and just look at where there's buyers and sellers. So we have a level here at 677.60 and we have strong sellers here at that 695 area, right? So I know that whoever bought at this candle will try to get out of that position because that's where they're feeling the maximum pain because they bought at all-time highs, and that's totally fine. Someone has to buy it at all-time highs, otherwise it doesn't continue. But if I'm a scared investor, whether it's retail or institutional, doesn't matter. I'm looking to sell as soon as I come to break even, right? And because of the way that the market is structured right now, and it's nothing against the US economy or the government, I'm not trying to get political here, but just the way that the macro environment is folding out, we're in accumulation mode. We're not in breakout mode above or below. Like this is just all accumulation for a move upside or downside. So I know with high probability, and once again, trading is a probabilities game, when I get to the 695 area and we're not closing above it on a daily or 4-hour, 15 minutes, we're likely going to go down because there's a lot of serious sellers there. And there's also a lot of serious buyers at 676.60. So this is a pretty easy range to play in, especially if you're doing like 1 or 2 days out swings. You could do that, but I like the intraday better because frankly, that's where the risk and reward is right now. So that's how I do the key levels. Doesn't matter if it's on the 15-minute, 4-hour daily, like you're going to find the same story. If I come down to a 4-hour, I know with 100% confidence that area has been defended. Yeah, we've undercut them and reversed up really fast, but those buyers are still there. Same thing, those sellers are still there at that 695 area. Any other questions? No other questions? All right, it's rare. Okay, I'm going to reset this chart so we can see all the different levels that I've drawn over the past 4 months. It might take a while because I've done a lot here. I really don't want to redraw them. I'm lazy. Yeah, when in doubt, zoom out. I think that's the best thing you can do. I think we got really caught up in the intraday moves and the chop there, which is why I don't want to play post 10 a.m., but here are all the levels that I drew, at least the key levels. So I know there's a lot of good buyers at 675. We went over that. I know there's a lot of good buyers at 676, 677. And these are other places where there's really good buyers or have been really good buyers, right? And another thing we could do is look at the 4-hour chart because this will tell you if we're going to get a move up or down. Is there a pattern here that we can look at, right? So we might be forming an inverse shoulder, inverse head, maybe inverse right shoulder and go up towards 695. That's entirely possible. The opposite is also true. Maybe we get something like this tomorrow where we get a head and shoulder pattern. Left shoulder, head, right shoulder, and continues dipping down. No idea, but at least we can use the 4-hour liquidity and the 4-hour time frame here to zoom out and better understand where there might be serious buyers and sellers, right? And use the confluence that we have from different patterns, like head and shoulder, cup and handle, inverse head and shoulder, etc., to look at where there might be opportunities that we can play with, right? Let's go look at an example for UNH because I think that looked pretty good on the daily. Let's go see. So we have this nice cup forming on the daily side, right? I haven't drawn any levels because I don't think we need them, at least right now. You have a nice cup forming. You might get a channel here. That's your handle. And then we break towards the upside towards 350, 340 area, right? Because that's this gap and this high. So it looks pretty good on the daily towards move upside. I'm pretty optimistic that it does hit tomorrow. Similar story on the 4-hour chart. We had this impulse down from some news. I think it was earnings related. Now we've accumulated and we're going to do this cup. This is your handle. and go towards the upside and fill this imbalance, right? Imbalances are also good to understand, in all honesty, because imbalances typically get filled. They don't have to be filled on the same day. Like this is on the 4-hour chart, and it obviously has not happened on the same day. But this is where there's a lot of imbalances in terms of liquidity, right? So you also have a fair value gap here. So it's likely at some point in time, it doesn't have to happen tomorrow or today, that we're going to go target the imbalance because this is your middle ground between buyer and sellers. And if you close above the 50% imbalance, you're going to be net buyers. If you're closing below the 50% imbalance, you're going to be net sellers. That's just how I understand it. You can correct me if I'm wrong. But the way that I understand this is whenever we tag a layer of liquidity at an imbalance, if you're closing above the 50% line, so like above here, you're going to go towards higher highs and higher lows, because that's when people become net buyers or institutions become net buyers. And under this, at the 50% mark, they're going to become net sellers. And that's kind of what we got here, right? We tried getting above that level. We never did on UNH, but it's looking pretty good for swings on the call side right now. I'm not interested in buying puts on UNH unless it's for hedging, because I have this nice cup and handle forming. I have another layer of confluence that there's imbalances above. And I know there's a bunch of liquidity at the 342, 350 area, right? So like all I had to do was just draw a simple line and understand the patterns where there's buyers and sellers. And I think I'm pretty optimistic in taking 350 or 360 calls a couple of months out from now. So same story, different asset, but you can see it kind of working the same way as we did it on SPY. And yeah, it's not supposed to be rocket science. Like, I don't know shit about trading. I went to art school. What do I know about this, right? The only thing I know is how my trading strategy has worked for me. And you might have a different strategy. That's totally fine. But I also know with full confidence that until we're closing below 677.60, I'm not swinging puts. And until we close above 690, really, I'm not swinging calls. Any questions? I did not go to computer science school because I'm not smart enough. My grades were not that good. All right, let's go look at other things that are interesting. Okay. We also have themes in the memory and storage names. I went over this briefly in the morning call, but the demand for memory and storage because of the data center demand and because of where money is flowing towards energy utilities and critical minerals as well, I think we should start looking at that more seriously. The reason they're not slowing down is because of all the demand that's coming from data centers, from people trying to figure out how they can stay ahead in the AI race. And when you look at the companies that are increasing their capital expenditure, it's going towards memory, energy, and storage, right? So I don't see why I would bet against where Google's spending like, I don't know what it is, like $30 billion, where Oracle's spending like $30 billion, where Meta and Apple are spending, okay, not Apple, Apple's doing their own thing. But like every single company in the world right now, if you're playing in the AI space, you're buying memory, energy, and storage. So do I want to bet against the big guys that are deploying $60 billion of cash or $30 billion of cash each? The answer is no. So do I think SanDisk, Micron, Western Digital go a lot higher based on the capital expenditure that these companies are doing? Yeah. Do I want to trade them? Hell yeah. But this is where I feel comfortable doing swings because I can withstand the drawdown. I'm going to buy both commons on these particular assets, but also buy options and leaps in particular. I know they're going to be expensive, but the leaps are worthwhile here because the demand for all this stuff is not slowing down. And Western Digital, SanDisk, Micron are all sold out for the year of 2026, and people are now trying to reserve their 2027 capacity, right? So if that's where the money's flowing, why would I bet against the people that are deploying serious cash as a small retail investor? I'm using small comparatively because even if I have a portfolio of like 500K, that's chump change compared to like $30 billion that like Google and Meta and Microsoft might be spending, right? But if those companies are spending money and they're not able to recuperate it until 2027, then I want to find the individual stocks that will benefit from that. And these are the companies, SanDisk, Micron, Western Digital, and some of the energy companies. And we've also seen from the rotation page from George that energy is picking bids. So we're getting a lot of inflows into XLE, for example. We're seeing some rotation happen into XLP, which is the staples. And we kind of saw this happening nicely. This to me is like a nice trending market, higher highs, higher lows, accumulation here. And I think you're going to go towards higher highs and higher lows once again when you form that cup and handle. So that's really how I'm looking at that. And then we can also look at the rotation page all day and every day, but we also know that companies like Walmart are reporting like record earnings. Whether they sell down on that news or not, I have no idea, but I'm pretty optimistic that it goes towards higher highs and higher lows. And I've already started a position on Walmart comments. I've never bought Walmart in the past because I've never had to, because I didn't think consumer, retail, and discretionary were places I wanted to be. And then we should also talk about the macro environment a little bit, right? So tax returns are coming up. People are going to be paying less tax than I think originally expected, or will be getting higher refunds. That's going to hit the market at some point in time. Whether that happens in the next 2 weeks or in March, that's likely going to happen. So you're going to get an inflow in the S&P 500 into these stocks that people want to buy, like Micron, SanDisk, and Walmart of the world, and even Costco, because Costco's looking pretty good right now for both leaps and long-term investing. Again, this is a trending market. Higher highs, higher lows, right? Accumulate, go up. I think that's what's likely going to happen. But once those tax returns hit, you're going to get an inflow in the capital markets, and then maybe we can start breaking out towards the higher highs and higher lows on the S&P 500 and QQQ and whatever. But until that happens, I'm going to start these positions and know that I'm happy to take the drawdown, because I want to own SanDisk, Micron, and Western Digital until 2027, and then I'll reevaluate what my portfolio is, because the money is, I tell you with 100% certainty, it's leaving companies like Microsoft. This has been an absolute dumpster fire for me personally, and I bought at the top here. Like, I've been averaging into it for 8 years. I've definitely bought at the top here, and I'm down on that original position that I had. So I'm not buying companies like Microsoft or Apple. Like, I have some small amount of shares here, but it's not going anywhere. And maybe we break out of this range, but until that happens, I don't want to swing them just yet. So that's how I'm also setting up a position, and I'm going to be diamond handsing the Western Digitals of the world, because I know that they have a lot of demand and not enough supply. So that's how I can also boost my confidence in that trade, or that asset in particular. Any other questions? And I want to show you some stuff on George, because I think it's good to look at. Let's see what Apple does post-market. Meta's doing some weird shit here, but I think it's going to move up tomorrow. S&P 500, they're probably going to sell it off and then recuperate that tomorrow for OPEX. Oh yeah, let's go look at the Greeks and some of the option stuff. Give me a sec. I'm going to open up the broker that I use, and we'll change the screen share here. Okay, let's go look at the screen. All right. So this is a broker that I use. I have a relatively small trader account here, but it is what it is. I'm up 1,500% on that. Nice. Okay, let's go look at, I'm just going to take TSM for example, and we'll look at the options. Delta is important because the way that theta, and by the way, these are all tools that are built by market makers to manipulate us out of our hard-earned money, and that's totally fine. We just got to understand how it works. Anything that's close to the money will be less affected by theta than things that are out of the money. And you can look at deltas, and you can see the deltas on here, I think. I think you can see them. Let's go find out if we can or not. We have to go to the advanced mode. Okay, this broker is kind of trash. It doesn't give me the numbers there. But anyways, the lower the delta is, the closer you are to the money. You want to buy contracts that are close to the money as much as possible, and use out of the money like 372, 370 here is out of the money options and lottos. Because when theta hits, and it hits really strong the day of, and especially after 12 p.m., the out-of-the-money contracts will decay faster. Their price will drop faster than in the money contracts. It's just how it works. If I look at the theta delta curve, I think there's an image that I really like. Here it is. You want to find things that are like within the midpoint here. And you can look at the gamma spread or the delta spread to better understand where that is, right? And so price will drop the value of the out-of-money strikes. So you see that here, and then in the money strikes will go increase in value, because that's just how theta works and delta works. It's good to understand it. I don't fundamentally understand it that well, because I'm looking at this as a trader, not a long-term investor. Warlock is really good at that, so you should do a class on the theta and the delta there, but you want to buy as close to the money as possible if you can afford it. Just because it's cheap doesn't mean it's the right thing to buy, because that'll hit theta and hit decay really fast, especially after 12 p.m. the same day. And if the move is not going in your favor, for example, if we bought TSM calls tomorrow, I write it open for a 370 strike at $49, and we're not pumping towards 370, like that's going to decay much faster than something like 362.50, or in the money will be like relatively stable at 370 here. So it's just good to be mindful of that. You don't want to buy far the money contracts, especially on the S&P 500, because it'll decay much faster in price than stuff that's close to the money or at the money or in the money ideally. And one trick I really like using, and I did this last year by sheer luck and coincidence. Let's go find the SPY chart and look at it here because it's good to see. Let's go look at 1 year. When this thing was happening, I just bought in the money calls. I think I was buying like 520, 530 calls for like a year out from then, from April 21st, 2025 to like April 2026, because it was worth the risk. And I just didn't look back at them. And those are the stocks or the options that have gone like 100x, right? And I really like those plays when everyone was panicking. I was like, I'm just going to buy when VIX is like 30 and above. And I think we had VIX at 70 in COVID. And once during the 2008 crash, and I don't know if we got that during the tariff era, but whenever VIX is peaking like above 30, I'm just buying in the money calls a year from now and just chilling. I don't have to do anything. I'm okay with the drawdown, but it's worked out really well in my favor where I can just keep a position open and let's go see what it's going to cost if I get in the money for February or March 2027. If I have that here, let's go see. Okay, January 2027, in the money calls will be. Let's go find out what the number is. Let's see if I want to get the 670 strike for $66,000 here, $6,800. It'll be much cheaper than buying, at least right now, 100 shares at what's the price that we closed at today on the S&P 500? 684. So I'll be spending 68.50 here to buy 100 shares in the future. This is in the money at 670. So I'm getting a 10-20% discount here compared to buying 100 shares of the S&P 500 at 684.22. So that's another trick you can use. Like if you really want to buy that asset and you're able to afford that contract for in the money a year out from now, it's a really good tool to use because you're effectively getting the same amount of shares at a discount. And more likely than not, you're going to be going towards a higher level in a year from now than you are, today. And if it drops in price and I get a discount of like 20, 30% for maybe even like 50%, hell, call it that. If I get a discount of like 20, 30% for a stock that I want to own, and I'm able to add to that lead position, I will 100% add it because I want to own that stock and I'm getting it at a 20, 30% discount, right? So I really like that trick personally, where I can get the 680 calls that are in the money a year out from now for $6,100 for 100 shares, then spending $6,840.22 on buying 100 shares today, right? The savings there for me as an investor, if I want to, if I want to buy the S&P 500 a year out from now, it's cheaper to get the option that it's in the money, coincidentally, than buying the 100 shares today for the market value. Any questions on that front before I go to my last topic here? For some shares, like I was doing this on ABAT because I have a couple 100 shares. I don't really understand spreads. We've been over this. I'm not very smart. I don't understand how spreads work or credit debit spreads. Warlock is really good at that. I've done some cover calls and selling puts on, assets where I have 100 plus shares, but it's pretty rare for me to do that because it's just a matter of knowledge. And for me, I'm not comfortable with that because I don't know anything about it and it scares the hell out of me. So I don't do them as much as I want to, right? Like I love being able to do the wheel strategy. I think you can go Google this if you want. You just buy 100 shares of a particular asset and then sell the puts or sell the covered calls and you make money on every single time. And that's cool. If it works for you, it works for you. I've never tried it. I'm kind of a wuss there. I don't know how that works and it scares the hell out of me. And frankly, the companies that I want to do this for are the companies that I want to own. Like I have 100 shares in Micron, I have 100 shares in the American Battery Company, 100 shares on plus shares on like some defense names that I really want. I don't want to lose them. I don't want to lose those shares. So I don't want to do the strategy. I'm sure you could do it and find success in it, but you got to get comfortable with that strategy and really understand it. I'm a dummy. I don't understand that, so I don't do it. And the closest I've done is like selling covered calls and selling puts, but I've only done them like a handful of times. I think I can recall every single time I've done it, and every single time I got scared. I just took the small, 10% gain, and call it a day. All right, my last topic here. Let's go look at the rotation page on George because I think it's good to see, understand where he's seeing market inflows and outflows. And we went over this a little bit earlier on, but like the market is standstill right now. It's in this neutral phase. Like money is moving out at the same rate as coming in. It puts us in a weird spot where we can't really swing things long term unless it's companies that you want to own. We went over them already. And George gives us really good signal and idea of like, hey, you've got this, month over month, day over day, week over week change. You're neutral across the board. That's fine. We're in mid-cycle. Risk is off, or at least might be off. We're in neutral, so we don't know. We might be risk on, risk off, no idea. But I know with 100% certainty, utilities, energy, and real estate are catching bids, right? So we know that money is flowing towards these sectors. And the money that's going in is pretty strong. Like it's, a few $100 million. That's actually a pretty low number. I've seen it like a couple billion. He's looking at 500 plus stocks. He's got a couple of picks for shorts and longs. He's bearish on Apple in terms of swings, not in terms of like 1 day options or one or 2 week out swings. He's thinking about this as like, hey, this is what is likely that's going to happen in the next like 2-3 weeks. That's really how he's looking at this, right? So when I see this stuff and he's giving us short setups, these are for like a week or 2-3 weeks out from now. They're not for like tomorrow. They're not for the next couple of days. But this is really where he's seeing market inflows and outflows. So if you're long on technology, this is not the right time to be long on technology unless there's particular stocks that are performing really well because we're in a stock pickers market like SanDisk, Micron, SNDK. Discretionaries outflow, financials outflow. Let's go look at the JPM chart while we're here because I think it's also going to be dumping or in a trending down market. Let's go see. Daily, yeah, it's looking like you're going to, eventually implode. I don't know which way you go, but if interest rates go up, they're going to go down. So money's outflowing from technology, from financials, from consumer discretionary and services, and going towards utilities, energy, and real estate. And we can see that clear as day when I open the XLE chart. Like this is a trading market where you're going to higher highs and higher lows. So why do I want to bet against that, right? And the answer should be, I think for everyone, it is for me. I don't want to bet against that, so I'd rather take the long on utilities and energy. So I've already got leaps on XLE. There's 70 calls for January 15, 2027. They've already started paying me. Like that's kind of nice. And I started buying a position on XLE where I'm just buying comments. I think it's $100 every week at this point in time because I know the data center energy demand and storage and memory demand is not slowing down. If anything, it's increasing. So I want to be positioned where there's less supply and more demand. So that's how I'm thinking about this. Its top picks are pretty good for the most part. I think long term, not long term as in like a couple months out, but short to medium term, 2-3 weeks out from now, this is what's likely going to happen. You're going to get a down move on Apple, on Tesla, JPM back, but you're going to get up moves on utilities, energy, and energy, right? So this is where the money's flowing, and I'd rather just take a note of that and understand if I was a swing trader, I can get options into these for calls or puts into some of these for the things that I don't want to own, and also get some commons for the things I do want to own where the long setup is existing and where we know that money's flowing towards, right? So that's helped me quite a bit because I can tell you with 100% certainty, I would have never looked at CVX if it wasn't for George. Same with NEE, I would have never looked at it. Same with XLE, for example. I would have never looked at it in the past because it's not in my universe of things that I usually trade. And what I was trading for the last 18 months or so has been technology. It's been like companies like Palantir, Apple, Tesla, the S&P 500, and QQQ, but it's just not been the case where we've been consolidating for the last like 4 or 5 months. So that's how I really like the rotation page. It helps me understand where the market is moving, and I can set up positions for a couple of weeks out from now, a couple of months out from now, based on that kind of signal and based on that kind of confluence. If you want, you can look at the analysis page. It helps me sometimes where I look at the ICT analysis, for example, and I just figure out where the right levels of support and resistance are, right? And you can go and identify these zones really easily. And these are also key levels. And coincidentally, or maybe not coincidentally, they match up really nicely with our lines that we drew on the chart, right? So again, I just automated the way that I trade, and it's working out really well. And then here's your pivot points where price is likely to reverse. So at 686.29, it's going to go up or go down, but this is a nice point of control. Here's your pivot point. It's the same, or it's very close in number. So at 686.09, around that area, I want to watch and see if we go higher or lower because that's a decision point, right? And I really like how George does it. I use it sometimes, but again, those levels are already on my chart, so it is another point of confluence and usage. Every Bob member, by the way, has access to this tactical hub. You can put your own stocks in there, and George will pump out a summary. Bearish on Reddit, long on ONDS. Canva just says neutral, and we kind of got that on. If you look at the CNVA chart, or CVNA, whatever it's called, they dumped after earnings, and then we ended up reclaiming some of this liquidity, and then we ended up consolidating, right? So he's right to be neutral because it's just ranging right now. It's all accumulation. So he identified that without even me looking at the chart. It's kind of cool. So you can add your own tickers there and then better understand where the market might be heading for the things that you want to trade and buy. And then the way that he understands liquidity and the way that he works, and he'll call it out here exactly, is if you sweep 676, you should buy the 684 strike a couple of days out from now. If you sweep 689, you should buy the 683 put strikes a couple of days out from now, and this is your target. I really like this because this is how exactly my chart is structured, and I know where there's levels of liquidity that I want to start taking profits for, right? So you should use this for context and for confluence for where you want to get into a position, and he uses that when he's trading as well. And you can filter this down if you wanted to by bullish, bearish, or neutral. I really like looking at the bullish ones. I love swinging calls, and I like calls better than puts, but that's just how I am. So I'm looking for the bias towards, Amazon and looking at his targets and his levels that he's understanding and where my entry is. So if the entry on Amazon is at 196, I'm going to buy the 205C when that level hits. I think I actually did hit already. Let's go look. So at 196, which is right here, what happened? We swept liquidity and went higher. Like if you don't believe how George's structure works, like you can see a clear example of this right here. Swept the lows at 186 and your target is 211. Let's see if we got to 211 and rejected. We got to 206 and rejected. We were very close. But maybe it goes up tomorrow. I have no idea. But that was the right entry, and you would have taken the 205Cs and made like 200, 300% right. So at least I know that the strategy that I have and the way that I've built George is working. And he's saying if you sweep 207, you should take the 202.5P and your target is 197, which is, again, that level below. What happened? We swept the highs at 206, almost got to that 207, and then we ended up going down towards that 202 area. And then we bounced up from there. So again, you have another layer of evidence or another tool that you can use in your arsenal for when you want to buy short setups as well. And it worked out the exact same way. He said, hey, if we hit that 207 area, which we kind of did, you should buy those 202 calls, or 202 puts rather, and we ended up closing right there and reversing up. So there you go, more tools in your toolkit. But we'll see how that goes. Swings are good to look at as well. I don't take most of these except for the ticker liquor because we're not in a trending market. I don't want to swing anything too much unless they're hedges. And the flow is also there for you to look at. This is powered by Unusual Whales, and it worked out really well. And George will do his own analysis, and you can click on George's picks to better understand the things that are interesting to him that matches the confluence from the flows, right? So in 211 days, you have silver calls. Could work really well. American Airline puts, AL, I think that's what it is, 57 days, and SPY puts, 4 days out from now. It might be worth taking, it might not be. It's up to you what you want to do and do what you're comfortable with. But whenever some suspect flows come up, I take one or two of these with high conviction, and I use the flow as confluence for that direction. So that's how I really like using it. And you also have gamma exposure here, so you can look at, where the spin zones, where there's risks, and where dealers are positioned. And we really got stuck between this range at 685 and 680 here because that's where you have your biggest layers of liquidity. And we just ended up ranging that. So if I go back to the chart and look at the SPY chart for today, because that data is from today, we got exactly that. We just ranged between these two levels and nothing else. So hopefully that helps. And I know we went a little bit over here on diamond hands and different strategies and different things to look at, but I really want to make sure that people understand how to trade effectively and where the targets are and how to plan around the best case and the worst case. And once you understand that if you sweep a level below or higher, you're able to take a call and a put respectively, and you have targets both on the chart and both on the George's levels there. So hopefully this helps. If you have other recommendations or questions that you want to cover, let me know. I do have enough knowledge here for the most part on being a really effective trader, and we're not going to win 100% of the time. We're going to win 90% of the time or more. And that's really the target that I'm striving for. And George is a really good tool. He's a better trader than I am, frankly. I was doubting him on the puts that he bought at the bottom today, but he ended up making money on those. So you could also do this, just buy all the trades that George does. And in most cases, you will be right, because if I look at his performance page, and let's go through that really quickly, he's crushing it. He's making more money than I am right now at a 80% win rate. But you don't have to be right 100% of the time. You just have to be more right than wrong. And that's what George is really good at. You can break it down by he made a lot of money on the S&P 500. That's his best performing ticker so far. So just keep that in mind. You can also just take all of his plays and see which ones work and rinse and repeat. And hopefully get that 78% win rate here. Any last questions before I close out the call? Going once, going twice. All right, I'll post the recording afterwards, but hopefully this was helpful. If you have any other questions or topics you want me to cover, feel free to ask, and I will set up some time for those. And let's continue making money together. Welcome to George. Happy to have you here, and thanks for your time. We'll chat soon.